It's countdown to the monetary policy announcements. Thank you for staying tuned. I am MPC at Debayo. The Central Bank Governor, Godwin Emefiele, will in a very short while announce the decisions of the Monetary Policy Committee. Meantime, this is what the committee did at its last meeting in July. Now, the committee voted to retain the MPR at 12.50%, retain the CRR at 27.5%, retain the asymmetric corridor of plus 200 to minus 500 basis points around the MPR, and, of course, retain the liquidity ratio at 30%. But I still have with me my panel of discussants, Dr. Muda Yusuf, who's the Director General of the Lagos Chamber of Commerce and Industry, the CEO of Capital Bank, or Ms. Igweje Higo, and, of course, Dr. Magnus Kpako, who is the Chairman, CEO of Economic and Business Strategists Limited. Thank you all, gentlemen, for sticking around. Now, let me begin this side with you, Dr. Yusuf. Of course, the MPC is expected to brainstorm on a couple of critical issues, but what is the appropriate policy dosage to apply to restore GDP growth?
Well, the appropriate policy disposition should be policies that inspire the confidence of investors. And this is a combination of policies, particularly from the monetary side. It's a combination of this interest rate policy, improving access to finance, which the CBN is doing quite well about in terms of the intervention funds, in terms of all the policies that are bringing down the cost of credit, in terms of development, finance, and all of that. But it's also important that we get the foreign exchange policy right. Just as Dr. Kpako said, that is perhaps the biggest challenge that we are facing in the economy now. And if we don't get it right with the pricing, with the allocation mechanism, the CBN will continue to face very serious distractions. The CBN will have to be fighting many fires that it will be very difficult to put off. So it is important that, good as all these monetary interventions are, we need to complement it with the right foreign exchange policy. We cannot continue to have the kind of exchange rates multiplicity that we have. We have the CBN official rate at 380. We have the NAFEX rates at 385. We have the MoneyGram at 380. We have export proceeds at 386, and then we have the parallel market at 465. The implication of this is that this policy is going to continue to drive demand, and it will continue to suppress supply, which is not what we need at this time. What we need at this time are policies that will incentivize supply of foreign exchange. We already have challenge with the oil and gas sector, with oil price and all of that. But we have other sources through which foreign exchange can come in. We have the FDI, we have the portfolio investments, we have the diaspora remittances, which used to be as high as $20 billion US. We have the export proceeds. If you continue to maintain this kind of pricing policy in Forex, this supply will not come from these other sources. So that is the main challenge which I see that we are facing now. And the Monetary Policy Committee, I'm not sure to what extent they deliberate on these Forex issues. But that is the most important issue now. If you want the monetary policy and the central bank to help this economy to accelerate the rate of recovery, because we need liquidity in Forex. And oil and gas is not the only source of liquidity. We have other sources of liquidity. So unless we get these policies right, we continue to suffer a lot, because administrative allocation of Forex has always been a problem, and will continue to be a problem, no matter how well-intentioned the CBN may be. It's very difficult to manage. And it creates all sorts of problems, all sorts of distractions, transparency problems along the entire chain of Forex management. So it's something that I think we need to look at very urgently.
I'm sure they're listening, and we'll see what will be done. But then, Mr. Higo, what are the available alternatives to pull back inflation to below 12% and resolve the dislocation between the market rate of interest and real return to attract offshore investments?
Sorry, I think that's the million-dollar question. But I like what Mr. Lawal said. I think he dealt with the issues very clearly.
Mr. Yusuf, you meant.
Can you hear me?
Yes, go ahead.
Okay, good. Like I was saying, Mr. Yusuf, I like the points he made. Okay, so your question is, how do you bring down inflation? How do you get the economy growing again? First of all, if we get the foreign exchange policy right, if we increase liquidity in the FX market, if we allocate it efficiently, we have an efficient mechanism of allocating. If we're also able to have a situation where foreign portfolio investors perhaps are looking back into Nigeria and bringing FX and increasing the source of supply, increasing liquidity, that would help growth, because then people will have more access to FX. They will use it for productive, for factories, for retooling, spare parts, raw materials, and so on. And hopefully you can get the productive capacity of the economy moving forward. That would have a positive impact on growth of the economy. And once you start producing things and the productive side of the economy is growing, then hopefully you will see a drop in inflation. If you are growing more food, you are growing more products, then you're likely to see inflation come down as prices begin to moderate because of the increased supply. So it's important that the FX policy is gotten right. Then a lot of the structural things that they need to do to the economy, they need to keep working on that. I mean, as a nation, we need to keep working on that. So, for example, I go back to fuel subsidies. We need to sort out these issues of fuel subsidies once and for all. So the government has to communicate with the public. They need to level with the public and tell you, this is the way forward. We can't survive with the level of subsidies that we've had to pay over the last few years. Electricity tariffs, we need to get the power sector moving again. We need to attract investments into the power sector, and hopefully that will engender growth. That will make it easy for them to be productive factors. And the third leg of that will also be the FX policy. So if you get the FX policy right, if you sort out the issue of fuel subsidies, if you sort out the issue of electricity tax, and you are improving on that on an ongoing basis, in the medium to long term, you're going to get economic growth coming back up, and you're going to see inflation moderate. So it's a combination of those three things, both physical and monetary. You need to combine them in the right proportions to drive the economy forward. But like was said by Mr. Lawal, I think his name is Lawal, we need to get the FX policy right, because that one we can control. I always like to look at things you can control and things you can't. That can be controlled. That would have, whatever you do will have an impact on people, will have an impact on the nation. But that we can control. We can have a more efficient way of allocating scarce FX resources. We should look for ways to increase liquidity. And once you get that right, then you can work with some of the other things I've said, and you have the economy growing back up. But there's no quick fix. And it's going to be painful. Some of these things will have very tough consequences for the people of this nation. But once we go through them once and for all on the right path, then hopefully we'll have a better future.
Thank you, Mr. Higo. Now, Dr. Pakol, in terms of stimulating domestic savings and fixing the currency market illiquidity, is there any advice that you have to offer on that?
As I tried to say earlier, you want prices to allocate resources. So as my colleagues have said, I mean, if you were an investor coming into the country, and obviously it means you're buying the naira. Anytime you're bringing your currency into Nigeria to set up business or whatever, you're buying the naira. So you want the price of the naira to be right. So as it is now, as we've all said, that we're not quite certain where we are in that regard because of the various windows, the various foreign exchange windows that we have. So we got to make sure that we are signaling very well to the investor what our various prices are, so that they know what they're coming to get when they come into the country. And if they would want to remit some of their profits back, they also know exactly what happens. In this regard, we're not quite there yet. So we need to be able to handle that. But as I said also, a crucial pillar behind all of that is production. So, and this is something that you don't lay just at the foot of the central bank. This is something where all hands must be on deck. At the state and local government levels, of course, at the federal level, we've got to find ways to get the private sector, and by the private sector, I mean the regular guy, to be more productive. What does that mean? They have to have the resources to use. They have to have capital to use in that connection. There's something that we have been missing, and we can't ignore it, and that's human capital. So we've got to find ways that we invest in human capital very seriously. We're looking long-term now. So sometimes we look at these issues on a very short-term basis. You know, what do we do just today? But if you keep doing that, then the future keeps on unfolding to you in a very perilous manner, as we're seeing now. So we've got to make sure that we invest quite a lot in human capital development. So we got to do that to get our people to be able to produce goods and services. The number one asset we have in the country is the human being. All these numbers that we're going to be talking about today, whether it be the CRR, or the NPR, or the liquidity ratio, those things really don't mean much, except to the extent that they impact the human being. So where is all this impacting the human being? And for that human being to be able to rationalize these issues, to be able to put a handle on these so-called indicators that I put out, they have to have the capacity to do so. And that capacity rests in their human capital. So that's in sort of a long-term fashion. But in the short term, we have to be more prudent. An area that we ignore quite a bit is our governance. If we have leakages, if we have inefficiencies that prevail across board, then even the exchange issue we were talking about would not be adequately solved. So we've got to be more prudent in the use of our resources. We have to be more efficient with the little resources that we have. And when people have confidence that we're using our resources well, then they apply themselves very well. Now, if you look at people when they complain about electricity prices going up, tariffs going up, they complain about fuel subsidies and all of that. I think that if the people understand exactly what is going on, and they see how they have a role to play, and you find that we get a lot more done. What I'm just trying to say here is that we need to get our people involved in production. The other issue is the size of the economy is actually much bigger than we say that it is. That is in international dollar terms, not in market exchange rate terms. What I mean is that the informal economy is huge. That means there are a lot of people that are not in the radar of the government. They are not being engaged in mainstream activities. They are not mainstreamed. And so they are lost in the periphery. They're in an orbit of their own, and nobody's really working with them. And that's something that we should capture so that we know the ones to promote, the ones to engage, the ones to provide more incentives to. That's what other countries that have been very successful have done. You reduce the size of that so-called informal economy, so you can engage everybody that is producing. Then you have a better handle on your competencies and your ability to be competitive with the rest of the world. So I think that that's crucial. As I said now, in the long term, looking at human capital investments, in the short term, being very efficient and trying to capture much of the informal economy.
All right, Dr. Pakul, please hold on to your thoughts there. We're still counting down to the September MPC decisions, and we will be right back in just a moment. Please stay with us. Welcome back. Well, the CBN Governor, Godwin Emefiele, is already addressing the press on the outcome of the MPC meeting. But of course, the bad weather is actually preventing us from connecting. But then we'll be bringing you updates on the developments as they come in. In the meantime, let's continue the conversation now. And I will be coming to you, Dr. Yusuf, for this one. Now, at the last meeting, the CBN Governor, Godwin Emefiele, said that he expects a technical recession, but his tone was more of a V shape, if you look at it, supposedly midwifed by the various intervention programs. So do you expect any form of changes to the CBN's thinking on growth this year?
Well, I'm not expecting any major departure from that. But before I take that, let me just quickly comment on what Dr. Paco said about the critical importance of productivity in the economy. Because all of these things that you are talking about growing the economy, about diversifying the economy, about making the economy competitive, is all about productivity. And two critical factors. First, the factor of infrastructure and the factor of policy. These two things are very, very critical to promoting productivity. In the area of infrastructure, the government has a major role to play. The private sector also has a role to play. But if the economy is not performing well, because the government needs resources to be able to fix the infrastructure. If you have wrong policies in place, if you have institutions that are not properly supporting the growth of investment, then the government will not have the revenue. Because the growth of revenue, of government revenue, is positively correlated to the performance of the economy, which is also related to the growth of investment. So in all of this, it is very important that the combination of our policies, right from the forex policy, to the tax policy, to the energy policy, to the trade policy, all of these things must be in tandem to promote investment. Because if investment grows, output will grow. Even this inflation that we worry about, if there's an increase in output, it will moderate inflation. But we need the right kind of policy support for this to happen. He also made reference to the issue of the importance of human capital. This is about education and health. Again, the government has a very big role to play in that space. But what we hear all the time is that they don't have the finance, they don't have the funding. Again, where will the funding come from? The fund will come from an economy that is doing well. It will come from a private sector that is thriving. So at the bottom of all of this is to create the right kind of investment environment. If the investment environment is good, investments will grow, whether it is from foreign investors or from domestic investors, and government will make more money from taxation. So we need to get the nexus of all of these things right. Because sometimes the way government goes about some of these policies, there is too much of a short-term perspective. Maybe they are running after revenue, taxing people, regulatory issues, the port issues, and so on and so forth. But if we give more space for investors to perform better, the economy will grow and the revenue of government will grow. To fund infrastructure, which will impact on productivity, to fund education and health, which will also impact on human capital. So we need to connect these things together. That is the point I just needed to add to what Dr. Paco said. Now, talking about issue of technical recession, well, I think there's almost a consensus that there will be a recession, whether you call it technical or whatever. But the thing is that, in fact, some people believe that we're already in recession because of the kind of things they feel, the kind of difficulties that they feel in the economy as we speak. But technically, you talk of a recession when you have two consecutive negative growth or contraction in the GDP. And the possibility is very high, the probability is very high that we are going to have a contraction also in the third quarter. But our prayer is that the contraction in the third quarter will not be as intensive or as high as what we had in the second quarter. So whether it's going to be V-shaped or U-shaped, again, depends on the kind of policies that we provide. Because at the end of the day, it is the investment environment, it is the investors that will determine whether it's going to be V-shaped, whether it's going to be U-shaped. Of course, there are some external factors. We talk about the global oil price, we talk about all of that. But there's also a lot of domestic variables. Because this is a big economy, an economy of 200 million people. This is the biggest economy on the continent. So we can make a lot happen within this economy if only we create the right kind of environment for businesses to thrive. So if the policies are right, of course, some of these policies, just as Dr. Paco said, there will be some short-term challenges. There will be some pains. But as they say, there is no salvation without sacrifice. We have to make some sacrifices. We have carried on with unsustainable subsidies for too long. And that is why the economy is still where it is. So we have to make some difficult choices, which is what the government is trying to do. And I think there has to be proper understanding. And I also believe that the government needs to put in place measures to cushion some of these difficulties. But some of these policies are clearly inevitable. If you want this economy to move forward, if you don't want to be having an economy where we consume what we should leave for our future generation, because that is what the whole talk about sustainability, that's what it's all about. So to come back to your question, it all depends on a combination of factors. Whether it's going to be V-shaped, whether it's going to be U-shaped. V-shaped is that we come into recession and we quickly recover. U-shaped is that we stay at the low level for a long time before we recover. It all depends on the environment that we create, both for domestic investors and for foreign investors.
All right. Now, let's just remind our viewers that the CBN Governor, Godwin Emefiele, is actually briefing the press right now as we speak on the outcome of the MPC's meeting. But of course, you know how technology can be when the weather is particularly bad. But we're actually tracking the developments and we'll be bringing them to you as they come in. But meantime, Dr. Paco, now, in May of this year, the committee reminded the markets that the maintenance of price stability was the CBN's primary mandate, but nonetheless delivered a rate cut of 100 basis points. In August, the decision to hold the rates was attributed to the disruptions orchestrated by COVID-19. So what would you be expecting this time?
I always never like to forecast something that is about to happen, and rather to wait until it happens. But I think that's why I said earlier that they are in a tricky situation. I could probably see them leaving rates as they are, because on the one hand, as my colleagues have said, especially I think Mr. Yusuf also said it, that you have we had a very sharp decline in the second quarter, but then you have inflation at the same time.
Sorry to cut in there, sorry to interrupt you, but we actually have the live feeds coming from Abuja, where the CBN Governor, Godwin Emefiele, is briefing the press.
166 billion naira has been disbursed. Consumer credit, where 527.6 billion naira has been disbursed. Oil and gas, where 477 billion naira has been disbursed. Agriculture, where 287 billion naira has been disbursed. And construction, 270 billion has also so far been disbursed. On monetary aggregates, broad money supply rose to 6.93% year to date in August 2020 from 5.23% in July 2020, reflecting the increase in both net foreign assets and net domestic assets. Similarly, aggregate domestic credit grew by 6.94% in August 2020 compared with 9.43% in July 2020. Money market rates remained relatively stable in the review period, with some mild volatility reflecting the prevailing liquidity conditions in the banking system. The monthly weighted average interbank core rate increased to 7.38% in August 2020 from 6.25% in July 2020, while the open buyback OBB rate decreased to 8.39% in August 2020 from 10.12% in July 2020. The MPC noted the moderate improvement in the equities market during the review period as the all-share index increased by 5.78% from 24,174.75 on July 21, 2020 to 25,572.57 on September 18, 2020. On a year-to-date basis, however, the oil share indices decreased by 4.73% compared with 26,842 as at December 31, 2019. Market capitalization also increased by 5.98% from 12.61 trillion to 13.36 trillion over the same period. As a lead indicator, therefore, this improvement in market indices signposts the commencement of a broad-based economic recovery as far as we see today. The committee also noted the decrease in the non-performing loans ratio to 6.1% at the end of August 2020, compared with 9.4% in the corresponding period of 2019, due largely to recoveries, write-offs, and disposals. Committee expressed confidence in the overall stability of the banking system as reflected in the positive performance of the financial soundness indicators despite the persistence of COVID-19 pandemic. It, however, called on the bank to sustain its regulatory oversight on the industry in the light of the continuous fragility of macroeconomic indicators and the impact of COVID-19 pandemic and the growing risk of cyber attacks on business and economic activities. On the external sector, committee noted the resumption of sales to bureau de change in a bid to improve liquidity and ease demand pressure on the foreign exchange market. Consequently, exchange rate appreciated at all the windows. The Monetary Policy Committee observed the recent improvement in external reserves and urged the bank to maintain its prudent allocation of foreign exchange towards balancing supply and demand. The outlook. The broad outlook for the global recovery remains uncertain as the headwinds associated with COVID-19 pandemic persists, especially as new indications of a second spike in the rate of infections continues to dampen prospects of a near-term recovery. With several economies contracting deeper than expected, the global economy may eventually contract beyond the 4.9% earlier projected by the IMF, as the second round of spike in the infection rate has resulted in widespread localized lockdowns in some advanced and emerging market economies. In addition, the persisting volatility in global oil prices, which is likely to continue beyond the end of 2020, as indicated by the deliveries in the oil futures market, signposts the likelihood of a disorderly global recovery. The synchronized monetary policy accommodation by major central banks in both the advanced and emerging market economies portends the likelihood of a medium-term debt crisis, which may set the global economy into another downturn if not properly managed. On the domestic economy, staff forecasts suggest that the economy may continue to grapple with the effects of the pandemic throughout the rest of the year, with persistent focus on activities meant to reverse the contraction. MPC projects growth at positive levels during the fourth quarter 2020 or latest first quarter 2021, based on the anticipated positive results from the coordinated and sustained interventions by both the monetary and fiscal authorities. These interventions include the coordinated response of the monetary and fiscal authorities to curtail the spread of the pandemic, reverse the downturn in the economy, improve revenue sources in the non-oil sector, and encourage the build-up of fiscal buffers. Committee's consideration. Committee's considerations focused on major headwinds, exerting downward pressure on output growth and upward pressure on domestic prices and inflation. The key factors considered by committee as likely to exert upward pressure on domestic prices in the near term includes the prevalence of security challenges in the country, adverse weather conditions, causing flooding in some farming regions, the increase in petroleum pump price, the regulation in the electricity tariffs, low crude oil prices, and exchange rate adjustment. The committee noted that available evidence does not support the view that the rise in inflation was due to monetary factors. Rather, there is overwhelming evidence that the inflationary pressures reflect the prevalence of structural rigidities and supply shocks. Hence, the traditional tools of monetary policy may not be helpful in addressing current inflationary pressures. Instead, the useful policies will be the supply-side measures implemented by the CBN. In the light of this, reducing MPR will signal to our deposit money banks to lend more to stimulate growth, increase aggregate supply, which should dampen prices in the immediate term. Although the committee remains committed to its primary mandate of ensuring price stability, it however noted the need to address the structural supply side issues that are putting upward pressure on production cost and depressing economic growth. To this end, committee supports the various intervention programs of the bank towards stimulating production in the agricultural and the manufacturing sectors to increase aggregate output and lower prices. On financial markets, committee considered the impact of the dwindling capital flows on yields in the equities, bonds, and money markets. It, however, observed the improvement in the equities market from the second quarter of 2020, indicating prospects of medium-term economic recovery. Members also took cognizance of the prevailing low rates in the money market and below the lower band of the standing facilities corridor as being a distortion to money market operations. Committee noted the increase in aggregate credit and encouraged further expansion in credit to employment-generating sectors to expedite growth recovery. It, however, urged the bank to sustain its regulatory surveillance over the banking system to ensure that non-performing loans remain low. Committee also noted the rising public debt profile and urged the fiscal authorities to strengthen its debt management strategy, explore other sources of revenue, as well as enhance efficiency in public expenditure. It commended the combined efforts of the federal government and the CBN in providing the required stimulus to contain the pandemic and ease its impact on the Nigerian economy. The dilemma of monetary policy. The MPC was, at this meeting, confronted by policy dilemma. Whereas MPC believes in the primacy of its price and monetary stability mandate, it nevertheless was confronted with what policy directions to focus on given the contraction in output growth during the second quarter of 2020, which may lead to a recession if the third quarter of 2020 output growth numbers further show a contraction. It is therefore of the view that if a recession occurs during the third quarter of 2020, the committee will be confronted with proposing policy options in a period of stagflation. This is because, with the recent removal of subsidy on fuel price, the increase in energy prices, and the adjustment of the exchange rate, inflationary pressure will no doubt persist unless MPC considers options that will deal with the pressure aggressively. Committee was therefore of the view that to abate the pressure, it had no choice but to pursue an expansionary monetary policy using development finance policy tools targeted at raising output and aggregate supply to moderate the rate of inflation. At present, fiscal policy is constrained and so cannot on its own lift the economy out of contraction or recession, given paucity of funds arising from weak revenue base, current low crude oil prices, lack of fiscal buffers, and high burden of debt services. Therefore, monetary policy must continue to provide massive support through its development finance activities to achieve growth in the Nigerian economy. This is the reason MPC will continue to play a dominant role in the achievement of the goals of the Economic Sustainability Program through its interventionist role to navigate the country towards a direction that will boost output growth and moderate the level of inflation. Similarly, given that the currency adjustment was a causal factor in determining the price of petroleum products and energy prices, MPC believes that the CBN management must take bold actions to stabilize the exchange rate. Management was further enjoined by the MPC to continue to provide funding to sectors that will resolve the supply constraints in petrol pricing, energy pricing, and food availability. To support household consumption, MPC enjoined management to aggressively channel its funding to targeted households, small and medium enterprises, and consumer credit by further increasing its lending activities through its Nielsen Microfinance Bank. The management was also directed to ensure that deposit money banks respond to the reduction in deposit rates by aggressively lowering cost of credit to borrowers. As regards output growth, MPC noted that air and road transportation, entertainment and accommodation, food services and education subsectors were adversely impacted by the lockdown. It therefore suggested that more efforts be put in place to continue to provide relief and funding to these subsectors so as to catalyze growth and improve output numbers. Dealing with the causal factors of inflation. In the view of the MPC, so far, evidence has not supported the rise in inflation to monetary factors, but rather, evidence suggests non-monetary factors, here we're talking about structural factors, as the overwhelming reasons accounting for the inflationary pressure. Accordingly, the implication is that traditional monetary policy instruments are not helpful in addressing the type of inflationary pressure we are currently confronted with. What is useful is the kind of supply-side measures currently being implemented. MPC also expects that a downward adjustment in monetary policy rate may be necessary to further put pressure on our deposit money banks to lower cost of credit in aid of growth. Committee's decision. In the face of declining economic growth and rising inflation, the committee faced a difficult set of policy choices requiring trade-offs and sequencing. Following the above considerations, committee reviewed the choices before it, bearing in mind its primary mandate of price stability and the need to support the recovery of output growth. Consequently, committee noted that the likely action aimed at to addressing the rise in domestic prices would have been to tighten the stance of policy, as this will not only moderate upward pressure on prices, but will also attract fresh capital into the economy and improve the level of the external reserves. It, however, noted that this decision may stifle the recovery of output growth and thus drive the economy further into contraction. On easing the stance of policy, the MPC was of the view that this action would provide cheaper credit to improve aggregate demand, stimulate production, reduce unemployment, and support the recovery of output growth. Committee, however, observed that with inflation trending upwards, easing of the policy stance may exacerbate the current inflationary pressure through an increase in money supply. In addition, MPC noted the tendency of an asymmetric response to downward price adjustments by other depository corporations, thus undermining the overall beneficial impact of a reduction to the cost of capital. In the committee's view, a hold position will allow the economy to adjust to the ongoing stimulus measures put in place by the monetary and fiscal authorities to curb the downturn and allow more time for the MPC to assess their impact on the Nigerian economy. After the consideration of the three policy options, members were of the opinion that the three options to lose will complement the bank's commitment to sustain the trajectory of the economic recovery and reduce the negative impact of COVID-19. In addition, the liquidity injections are expected to stimulate credit expansion to the critically impacted sectors of the economy and offer impetus for output growth and economic recovery. In view of the foregoing, committee decided to reduce the MPR by 100 basis points to 11.5% and adjust the asymmetric corridor to plus 100 and minus 700 around the MPR. 6 members voted to reduce MPR by 100 basis points, 1 member by 50 basis points, and 3 voted to hold. 9 members voted to change the asymmetric corridor, while 1 member voted to hold. All members voted to hold the CRR and the liquidity ratio. In summary, MPC voted to 1. Reduce the MPR by 100 basis points from 12.5% to 11.5%. 2. Adjust the asymmetric corridor from plus 200 and minus 500 basis points to plus 100 and minus 700 basis points around the MPR. 3. Retain the CRR at 27.5%, and 4. Retain liquidity ratio at 30%. I thank you immensely for your attention.
Thank you, Governor. Distinguished ladies and gentlemen, that was the communique of the Monetary Policy Committee of the Central Bank of Nigeria for September 2020, that is post-COVID. We have tried, this is the time for questions and answers. We have tried to improve on the participation at this press conference. We have been able to invite some correspondents. So as we ease off the lockdown, so we are also easing off lockdown here.
On correspondence.
Yes. And we have some correspondents here. But we are going to be, we have to treat the gentlemen and ladies who are at home.
All right, we've just listened to the Governor of the Central Bank of Nigeria, Mr. Godwin Emefiele, reading out the communique of the Monetary Policy Committee. Of course, the committee has decided to reduce the MPR by 100 basis points from 12.5% to 11.5%, and also adjusted the asymmetric ratio to plus 100 to minus 700 around the MPR. Well, let's continue our conversation and let's get the reactions of my panel of discussants who have been with me in the studio. But let me begin with you, Dr. Paco. Did you see that coming?
Well, I thought that they would hold the MPR at 12.5%. I would not have, if I was to advise somebody, that I would not have lowered it to by that 100 basis points, because I know he tried to explain that the inflationary situation was not driven by monetary factors. But there's always a monetary component in there somewhere, and we don't have enough time to go into that. in the sense that that shows that there's a rapid increase in the quantity of money. At all times, when that happens, it shows that that rapid increase is greater than the increase in the quantity of output. Therefore, it's a monetary factor. But that notwithstanding, I can understand why they would want to lower the MPR by 100 basis points, fearing a much deeper recession. But I don't think that it matters that much. As I said at the beginning, monetary policy is blunt for the most part in developing countries, and I think he alluded to, Mr. Emefiele alluded to that. So what's going to be critical is what I may call his Emefielean pragmatic approach that he has brought to the table, which is quite good. I think that he has done a pretty good job being very pragmatic in running a monetary policy over the last few years since he's been governor of the central bank. Because for a developing country like ours, the monetary policy does not work using traditional tools, as he himself just mentioned. And so he's been able to be more pragmatic and be able to use more development financing to address matters. So I think that's what we're going to be depending on for the most part. On the other, he left the CRR unchanged, and of course, the liquidity ratio is at 30. So I think overall, I would have kept the MPR at 12.5%.
All right, Dr. Paco, of course, we don't have much time and we need to take everyone's reaction. So, Mr. Higo, I'm coming to you now. What's your reaction to the MPC's decisions?
Thank you very much. Well, my reaction is a bit of a surprise. My thinking and my feeling was they were going to hold everything constant, that they're going to maintain status quo and retain the NPR at 12.5. So it's a bit of a surprise, but I like the way his speech was couched. He talked about a policy dilemma, and they looked at retaining it, reducing or increasing, and they looked at the rationale behind each move and the likely impact, and finally decided to reduce. And even in the committee itself, you had some people voting, in a different way. So it shows you that these are not easy things to look at. But in the end, the majority went with cheaper credit, trying to make the banks extend more credits to the manufacturing sector and all the other sectors, and see whether that will drive growth and that will drive output. We'll see whether that would work. I'm sure that's would have to see, but it is what it is now, and I guess we'll see what happens over the next few months.
Thank you, Mr. Higo. Now, Dr. Yusuf, let me come to you for your own reactions. Did it also come to you as a surprise?
Yes, it's a bit of a surprise. I was expecting the variables the status quo to be maintained. That was what I expected. But I don't think it matters much, really. The change in NPR from 12.5% to 11.5%. I don't see any material impact of that on the economy as it is today. Because if you look at the money market, rates are already down. In fact, there has been a lot of argument around the fact that real interest rates are negative for savings and savings deposits and all of that. So the issue we have in the economy now is not so much about lending rate. It's more about all these other factors. And I'm happy he emphasized the need to address the supply side issues, because this is the most important factor for this economy. The supply side issues that can boost output, that can make the economy very competitive, that can create the jobs, and that can even bring down inflation. It's not so much the tightening of monetary policy and all of these other measures. Because what we have seen over time is that there has been too much emphasis on demand management, both at the monetary policy level and at the trade policy level. There's too much emphasis of how to muzzle demand, how to stop this and stop that. Rationalize it, ration forex, exclude some people. All these things are demand management issues. So I'm happy that the CBN is now seeing the importance of supply side issues.
Okay.
And supply side matters cannot be handled by the monetary policy authorities alone. The fiscal authorities are very critical to boosting supply. What we do to attract foreign investment is very important. What we do to encourage domestic investors to come into the space to invest, all these things are important. What we do about our ports, about our institutions, all those things are very critical in dealing with supply-side issues.
One other thing the governor referenced was the actions needed to manage inflationary pressures stemming from supply chain disruptions. So how does a review of the Form M policy address this? Please just answer.
The Form M policy, I think, is part of the disruptions that the CBN's forex policy has caused, because it has affected a whole lot of businesses, most of them SMEs. At the chamber, we have made representations to government. We have made representations even to the CBN itself. In this kind of economy, that kind of policy is not sustainable. Because the Form M policy is saying that whatever Form M has to be processed, it has to come from the original suppliers or original producers. How many players in this economy have the capacity to patronize the original producers? These are people who sell in huge volumes. So we need to take into account the character of the economy, the character of players, the capacity of the players in this economy, in all these policy measures. And it is important to deepen consultation, because consultation can help to enrich the quality of policy. And I think the CBN, I will advise that the CBN do more of that, because the players in the economy are better positioned, to be also to advise government on what policies are sustainable and what policies are not likely to be sustainable.
All right, one final word from you, Mr. Higo. How will the capital markets react to the reduction in the MPR? You have 30 seconds to give us your answer, because we need to wrap up quickly.
Well, I think the reaction will be positive, because if rates in the money market are going to even be lower, all things being equal, then investment in equities are looking much better. So hopefully we'll see a move from the money market to the capital market, to the equities market. So it should be positive. I expect the move to be very positive for the equities.
All right, and Dr. Paco, in 30 seconds, how would you think that investors will react to this?
I think that overall it is good. I mean, I think he considered all the variables. So I think that investors would look at... Nigeria is always a good and strong market for investors to look at, both domestic and international investors. So I think it's positive for investors, and I hope that they take a pretty good look at Nigeria and come to invest.
Would like to thank you all for coming on the program. Mr. Muda Yusuf, Director General of the Lagos Chamber of Commerce and Industry, thank you for coming on the program.
Thank you.
We'll also like to appreciate you, Dr. Magnus Paco, Chairman, CEO of Economic and Business Strategies Limited, and the CEO of Capital Bancorp, Mr. Igweje Higo. Thank you all for staying with us on the program. And that's where we end the show today. Thank you for watching. I am BC Adebayo.